Hey friends, I was trying to do this video the other day, but I was still really fighting a cold. You can kind of still hear it in my voice, but not as bad. But I was stuck on the algorithm about mortgage payments and paying down your mortgage and different ways that you can do it, like paying, every 2 weeks instead of once a month, and extra $100, extra $200, all these different options. But nobody ever pointed out the pros and cons of paying down your mortgage early. And I'm here to tell you that part of it, because this is what I'm all about. I like to give you guys a different perspective to kind of think through so that you can make a decision that's best for you based on your situation and your goals, because your financial situation, including purchasing a house and investing and all the things, it's like a little puzzle, and it fits different ways for every single person. And what might be a perfect puzzle set for one person might be like completely wrong pieces for someone else. So that's why I'm always here to tell you guys this information so that you can understand the whole picture, what puzzle pieces you can use that might fit better for you. So just think of it like that. But one of the things that I really don't realize or think that people understand is, let's say you were to pay, let's say, an extra $200 a month. I think the math to do that would be you'd pay your home off in about 24 years instead of an average 30-year mortgage, right? So if you're paying extra $200 a month, that'll significantly change how much you have to pay on the life of your loan, right? Especially because the first 10 years or so, it's mostly interest that you're paying. So if you're paying extra towards principal, you're paying down that house quicker. But food for thought, most people on average, like the National Association of Realtors did a survey for 2023, the average person lived in their home for max 10 years. So if you're the average person that is only going to live in your house for about 10 years or so, you're not going to see the benefit of paying down that mortgage in 24 years versus 30 years if you're only living in it for 10. Now, I know you must be thinking, yeah, right, Stacy, but then I'll still be able to have that money back when I sell it, and I'll be able to have more equity and blah, 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 blah. But think of it this way. You're essentially using your house as a giant piggy bank. If you do that, if you add that money in, you're just going to get that money dollar for dollar back out when you sell it. You're not earning any extra interest on it. You're just using it as a giant piggy bank. So think about it that way. Like, sure, you might, let's say you have a 5% interest rate, but what if you could invest in stocks or bonds or something and gain 10% interest? So you're basically losing out on a 5% gain because you don't want to have to pay interest, which I totally understand. I'm in the same boat. I hate having to pay interest to some Yahoo lender, but they're also giving you money to be able to purchase this house. So you kind of have to just, and I know there's the Dave Ramsey people and stuff. They're like, don't get a mortgage and have a 15-year mortgage and da 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 da. And that noise is kind of annoying to me, because it's like, I hate it when people say never do this or always do that. Like, don't listen to that. You don't want to, just shut that noise out. If anybody's ever telling you always do this or never do this, treat that as very highly suspicious information, because as I said a minute ago, your financial situation, including purchasing a house and doing all these things, is like a big puzzle. And what might be perfect for one person and worst set of people that are doing this puzzle over here might not even fit in your puzzle piece of your life. Okay, so just always be very leery of people, or wary, is it wary? Anyway, be vigilant in finding these people that are telling you to never do this or always do that. Just listen to what they have to say, but take it with a grain of salt, and make sure that you look at the numbers and make sure it makes sense for you, and that the math actually maths, and you're not just getting on the bandwagon because it sounds amazing. And that's what's really damaging with people like Dave Ramsey, because he is the type of person that will take on you emotionally and try to really get you into his little world and teach you all these things because it sounds so good. But in the end, it can be very detrimental if he's saying, like, never get a home equity loan, it's bad for you, and blah, blah, blah. But if you're able to not have 2 car payments at $1,200 a month, and you live in a commuter town, you have to have vehicles to get to your job, and you're going to be paying 12-14% on your auto loan versus getting money out of your home and having one $500 payment at 9% interest with that HELOC. Like, you have to really understand each person's situation is different, and you got to look at that math and make sure it makes sense for you. And this is what I'm talking about with paying down your mortgage. Maybe that's a great idea. Maybe it's not. You really have to look at it with the whole picture, with your both eyes open. And another thing to think about too is that might sound amazing to pay that extra $100, $200 a month, but if you don't have a savings account or an emergency fund established, you can get yourself in a lot of hot water. Like, this happened to my husband and I. We were so thinking we were doing a great job. We got our first house and we started paying an extra $100 a month towards principal, and it was so awesome until the job market dried up. And we had a whole, like, I don't really want to get into all the details, but my husband had gotten out of the military. He finished his service, and then he got called back on inactive ready reserve. So that's a whole other story. And so when he came back, the job market had dried up, and he was a military police officer. So he was looking for a job at the police department, sheriff's department. And at that time, there was a lot going on. The police weren't being funded, and there's a lot of uprising and issues civilly. Like, there were so many issues going on at the time that they were laying off all of their officers that had been on the force for like 10, 15, 20 years. So when they started hiring people back, they were only rehiring those people that they had to lay off. And they weren't even thinking about buying or hiring new recruits. It wasn't even a thought in their head yet. So my husband had to pivot and make ends meet, but we fell behind. Like, bless his heart, he was out there. Like, our neighbor was a tow truck. He owned a tow truck company, and he was out there towing vehicles at all hours of the night just to make ends meet. So you can't ever fault my husband for saying that he's not an amazing provider, because he will find a way to make it work. But we still fell behind on our mortgage, and we went into active foreclosure. Luckily, it all worked out, and we were able to pull ourselves out of it twice. That's a whole other story as well. But it is so frustrating when you've been doing so great and you have a great credit score and you're doing all these things that everybody's telling you to do, and you're not setting up an emergency fund. It doesn't matter if you're paying an extra $100 a month on your mortgage or $200 a month, because you can't tap into that easily. It's going to take a 3 to 6 month process, whether you're selling your house or getting out a home equity loan or line of credit, or even doing a cash out refinance. It takes time to do those things. And if you're 30 days past due, you're going to be putting yourself in a really bad bind. So my biggest suggestion, before you even consider paying down your mortgage, make sure you have an emergency fund established. That is the number one thing you need when you own a home: emergency fund. Because a foreclosure does not fall off your thing for like 7 to 10 years. And it impacts your ability to even rent a place, because your potential landlord is not going to want to see a foreclosure on them. That's going to look really bad to them, and they're going to move on to another applicant. Okay. So you have to be really, 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 really careful not putting yourself in a position that you could go into foreclosure. And sometimes life happens and there's nothing we can do. Like when the market tanked in 2008, like, these are things that people didn't realize, but we also have, in hindsight, looking at what happened and how ridiculous it was, and people that had no business buying houses yet were buying houses. So just be aware and keep your eyes open. See what's going on in the world. If you have questions, ask them. Ask me. I'm a great resource for anything that has to do with real estate or financial stuff. If I can't help you, I have people that I can connect you with. Like if it's a tax question or an attorney question, I can point you in the right direction of where to ask these questions to if you don't know, because it's like, that is the most important thing, is knowledge. If you know what the best situation is for you, the sky's the limit. Okay. And that puzzle of yours is going to be amazing. Have a great day, friends. Bye.